The United States and China are locked in a trade war, a conflict that has been escalating over the past few years. This conflict is causing significant pain for investors in both countries, leading to a volatile market environment. Equity markets are feeling the pressure, with stock prices fluctuating wildly in response to the latest developments. The dispute centers around tariffs, which are taxes imposed on imported goods. These tariffs are intended to protect domestic industries but often end up increasing costs for businesses and consumers. The United States has imposed tariffs on billions of dollars worth of Chinese products, affecting a wide range of goods. In retaliation, China has imposed its own tariffs on United States goods, creating a tit-for-tat scenario. This tit-for-tat exchange is disrupting global trade, causing uncertainty for businesses around the world. Supply chains are being disrupted, leading to delays and increased costs for manufacturers. Consumers are experiencing higher prices on everyday goods, from electronics to clothing. The trade war is a drag on economic growth in both the United States and China, with ripple effects felt globally. The conflict is rooted in a number of factors, including trade imbalances and economic policies. The United States accuses China of unfair trade practices, such as intellectual property theft and forced technology transfer. These practices include intellectual property theft and forced technology transfer, which the U.S. claims give China an unfair advantage. The United States also has concerns about China's growing economic and military power, which it sees as a threat to global stability. The trade war has escalated significantly since it began, with both sides showing no signs of backing down. Both sides have imposed tariffs on a wider range of goods, affecting industries from agriculture to technology. The rhetoric has also become more heated, with leaders from both countries making strong statements. There is no end in sight to the conflict, and the prolonged uncertainty is taking a toll on the global economy. This uncertainty is weighing heavily on investors, who are struggling to navigate the turbulent market conditions. Global markets have reacted negatively to the escalating trade war, sending shockwaves through financial hubs around the world. Both the United States and Chinese stock markets experienced significant declines in April 2025, reflecting the deepening tensions. The S&P 500, a key United States stock market index, fell about 14% from its all-time high, a stark reminder of the market's vulnerability. It recorded a loss of over 10% in April alone, marking one of the worst months in recent history. China's Shanghai Composite Index also suffered, dropping approximately 10% below its 52-week high, adding to the global market woes. The index lost about 1.6% during April, a significant drop that has investors on edge. These declines reflect growing investor anxiety and a lack of confidence in the market's stability. The trade war is creating volatility and uncertainty, making it difficult for investors to predict future trends. There has been some recovery since President Trump's April 2nd announcement, but the market remains cautious. However, the situation remains fragile, with investors wary of any new developments. Investors are closely watching for any signs of progress or further escalation, as the trade war continues to loom large. The trade war is a major risk factor for global markets, influencing decisions and strategies worldwide. The market downturns are a clear signal. Investors are worried about the long-term impact. They are uncertain about the future, unsure of how to navigate these turbulent times. The trade war is creating a climate of fear and uncertainty, affecting investor sentiment globally. This is making investors hesitant to put their money to work, leading to a cautious approach in the markets. Amidst the escalating tensions, prominent figures are urging dialogue. They recognize the economic risks posed by the prolonged trade war. Jamie Dimon, CEO of JP Chase, is one such voice. He has publicly called for negotiations between the United States and China. Dimon warns of the unintended consequences of tariffs. He highlights the potential damage to businesses and consumers. His call for negotiation reflects a growing concern within the business community. The trade war is seen as a threat to global economic stability. Other influential figures have echoed Dimon's sentiments. They emphasize the need for a negotiated solution. They argue that tariffs are not the answer. Instead, they call for dialogue and cooperation. These voices of reason are gaining traction. They provide a counterpoint to the protectionist rhetoric. They remind us that cooperation, not conflict, is in the best interests of both countries. Investors are bracing for more market turbulence. The trade war has injected a significant degree of uncertainty into the global economy. This uncertainty makes it difficult to predict market movements. As a result, investors are adjusting their strategies. Many are adopting a more cautious approach. They are reducing their exposure to stocks. They are moving into less risky assets such as bonds. This flight to safety is a classic response to uncertainty. Other investors are becoming more selective. They are focusing on companies that are less exposed to the trade war. They are also looking for companies that are undervalued by the market. This strategy aims to identify opportunities amidst the volatility. The key is to remain disciplined. Investors need to stick to their long-term investment plans. They should avoid making rash decisions based on short-term market movements. Market analysts and economists are closely monitoring the trade war. They are trying to assess its potential impact on the global economy. Arthur Boudagnan, chief strategist at BCA Research, believes the trade war will be protracted. He predicts a long and difficult negotiation process. Boudagnan has downgraded his outlook for Chinese equities. He believes the trade war will continue to weigh on Chinese companies. Goldman Sachs's Kinger Lau has also revised his outlook for the MSCI China Index. He now forecasts a 12% upside over the next year. However, Lau acknowledges the wide range of potential outcomes. He warns that a global recession could lead to a 20% decline in the index. Conversely, a trade deal could result in a 35% increase. These expert opinions highlight the uncertainty surrounding the trade war. There is no consensus on how the situation will unfold. Investors need to be prepared for all eventualities. China's counter-navigating the trade battlefield. China is not passive in the face of U.S. tariffs. Instead, it has adopted a proactive stance to counteract the economic pressures. The Chinese government has taken significant steps to mitigate the impact of the trade war, ensuring that its economy remains resilient. These measures include economic stimulus packages and strengthening trade ties with other countries, diversifying their economic partnerships. China has announced tax cuts and increased infrastructure spending to boost its domestic economy, aiming to create more jobs and stimulate growth. The government is also providing substantial support to industries hit hardest by U.S. tariffs, ensuring they can continue to operate and thrive. These measures are meticulously designed to offset the negative effects of the trade war and promote economic stability. In addition, China is looking to reduce its reliance on the U.S. market by exploring new trade opportunities globally. President Xi Jinping has made high-profile visits to Vietnam and Malaysia, signaling a shift towards stronger regional alliances. These visits are part of China's broader effort to strengthen trade relations with other Asian countries, fostering regional economic integration. China is also seeking to increase its influence in other parts of the world, including Africa and Latin America. The country is investing heavily in infrastructure projects in Africa and Latin America as part of its Belt and Road Initiative. These initiatives are part of China's long-term strategy to become a global economic superpower, reshaping the global economic landscape, seeking value opportunities amidst the rubble. Despite the challenges posed by the trade war, some experts see investment opportunities. Kai Wang, senior equity analyst at Morningstar, advises selectivity. He recommends focusing on undervalued quality companies. Wang points to pockets of robust growth in the Chinese economy. He highlights the consumer discretionary and technology sectors as areas of potential. Wang cites companies like Grab and China-U.S. as examples. Grab is a Southeast Asian ride-hailing and food delivery giant. China-U.S. is a leading Chinese liquor producer. Both companies are well-positioned to benefit from China's growing middle class. Wang also suggests the iShares MSCI Emerging Market ETF or EEM for retail investors. This ETF provides broad exposure to emerging markets, including China. It offers a diversified way to invest in the growth potential of these economies. The long game, preparing for different futures. The outcome of the U.S.-China trade war remains uncertain. It is possible that the two sides will reach a negotiated settlement. This would be a positive development for global markets. However, it is also possible that the trade war will continue to escalate. This would have negative consequences for both the U.S. and Chinese economies. Investors need to be prepared for both scenarios. They should adopt a long-term perspective. They should focus on companies that have strong fundamentals and are well-positioned for the future. They should avoid making impulsive decisions based on short-term market movements. The trade war is a test of investor patience and discipline. It is important to stay informed and to monitor developments closely. Investors should consult with financial advisors to ensure their portfolios are appropriately positioned. Conclusion: a crossroads for two economic giants. The US-China trade war is a defining moment for the global economy. The outcome of this conflict will have far-reaching consequences. Investors are right to be concerned about the potential impact on their portfolios. However, it is important to remember that markets are cyclical. There will be periods of volatility and uncertainty. The key is to remain calm and to stick to your long-term investment plan. By focusing on quality companies, diversifying your portfolio, and staying informed, you can weather the storm and emerge from this challenging period in a position of strength.